Hi everyone, this is Paul Lang from Disciplined Trading Strategies. I'm here to do a little market review on a video called The Bookmark on the Market. I actually put this into some PowerPoint slides to make it go a little faster and quicker, so I snagged a bunch of charts and outlined a couple things I want to talk about. And the first two slides I've actually taken and written out exactly what I'd like to say. I call this a bookmark on the market because I wanted to just freeze a moment in time here and review what my comments have been so there is no question in the future. It is very common after a major market move that all of the great pundits out there are explaining how they were right in some abstract way or another. There certainly can be legitimate confusion. Even when I talk, I discuss three different market evaluation time periods. First, the intraday time frame, which can flip back and forth from bullish to bearish even during one trading day. I discuss the intermediate term, which means the daily chart outlook for the next several days or maybe a couple of weeks. This is naturally bullish most of the time in a bullish market, but there are pockets where it can clearly be bearish. There's no point in entering swing trades when the market is about to fall for 3 or 4 days or a couple of weeks, even if it is a bullish market. And finally, there is a long-term outlook. This is the big one. This is the one so frequently debated and discussed on TV. This is looking for those major corrections or crashes or bear markets or whatever you want to call them, the ones that have occurred in 2001 and 2008, and of course many times before that in history. Also, even if you are listening to me discuss any time frame, I may make conditional statements. I may say, for example, I'll be bullish if ABC happens, or I'll be bearish if XYZ happens. If these conditions don't happen, then there's no concept to discuss. There's also a very sleazy concept that some people do I want you to be aware of. They may start calling for a market crash or a serious correction or whatever they want to call it. They may call for it right here. When it doesn't happen, they double down a month later and they say, crash coming, crash coming, crash coming. They keep doubling down month after month, week after week. And someday, of course, they're eventually right. Of course, there will be a serious market correction or a crash coming sometime in the future. And if you say there's one coming every month, you're going to be right one of these days. And then what they do is they go back and erase any letters on their sites or videos that had prior comments, and then they refer to the last one saying, look, I called this correction or I called this crash. Naturally, people following them religiously will know that they're way off, but for a lot of newer people who just start following them, or for any advertising they do, they think they're a genius. Those of you who have followed me for a long time probably know everything I'm about to say, but I just want to put this in stone. This video is about the long-term time frame, the big one. I've been bullish for almost a decade. It'll be a decade this spring. When I say bullish, I'm talking about the big picture. If you look down here, these are the current little scales I put in the DTS market letter. The intraday outlook, which of course changes from day to day. The midterm outlook, which generally is bullish but has bearish time periods. And the long-term outlook, which is the one that we're talking about here. This has been pinned to maximum bullish and has never ever moved 1/10 of a degree ever. I've never ever made a comment that would indicate that the market was going to be bearish big picture or was at any kind of a top at any point in the last 10 years. No one will find any information about me saying bearish market anytime since the spring of 09. I have not yet called a top on this market, and I am not now. That's what I want to discuss here today. It's important to understand that tops can come in three different ways. Let's take a quick look at where the charts are right now. This is as of the close, Monday, January 29th. That's where these charts were snagged. This is the monthly chart of the QQQ and the monthly chart of the SPY. They are identical for all practical purposes. Doesn't matter which one we look at. Here's the weekly chart of the QQQ and the weekly chart of the SPY. They are identical for all practical purposes. These are the two instruments I use to judge, quote unquote, the market. The QQQ, of course, is the ETF that represents the NASDAQ 100, which is about 95% of the whole NASDAQ market. And of course, the SPY is the ETF for the S&P 500. Between the two of these, we incorporate pretty much the entire market that we care about. You often hear news firms and CNBC refer to what the Dow did every day. There's a reason they discuss that, but the Dow is only 30 stocks and should not really be used for market analysis. Here's the daily chart of the QQQ as of the end of close, January 29th, and the same for the SPY. There are three ways that a top can form. As of right now, nothing has come close to forming. The first way is for the market to just slowly roll over while it continues to try to make new highs and fails. You're in your uptrend. All of a sudden it can't make new highs, and it begins just this slow rolling over process. This is the most difficult one because oftentimes the market will do this and never really crash. it just begins to roll over and goes into a downtrend. It may pull back a little here and there, and after a long time continue to grind higher and then hit lower. It may go sideways for a period of time before it heads lower. While this top can be accurately called, it is often late and also can be significantly off the highs by the time it is realized. This is why it's the least favorable, as it is the least profitable and the least reliable. The second way is for the market to have some shocking event happen after it has been up a significant amount, and this can become quite a subjective concept. What happens here is that we have the market that has been heading up, and it is at the point that it is pretty extended, whatever that means. Boom, and then all of a sudden something happens and a sharp sell-off one day or a gap down gets things rolling, and then from there the market never recovers. We are perhaps on the cusp of entering that level right now, where some kind of shocking event may trigger events that get big money selling and form a top here. This type of top has not really happened in a long time. The third way is for the market to accelerate through the famous term of irrational exuberance and simply exhaust itself to the upside. When this happens, the market is in some kind of a strong trend. It becomes what people call extended, which doesn't mean much. It begins to accelerate, it goes parabolic, and we exhaust people, and then there's no choice but for it to start collapsing. This is what happened in 2000 and in 2008. This is the best kind of top if you are skilled in finding it and you have the patience. Many people have already called this market a top 27 times in the last 2 years. This type of top has not come close to forming as of the first of this year. Since the first of this year, there are the beginning signs that this may be starting to happen, but we're not there yet. Not to the point that I would even begin to trust a decline at this point. As a good rule of thumb, when the calls from the pros start coming in that the market crash is inevitable, add about 2 years and you'll probably be pretty close. Also, understand as I go through this video, I have a flaw that I constantly need to monitor. That is that I am a bearish person by nature. Naturally, I follow charts 110% and I act bullishly or bearishly accordingly to what the charts say. I just mean that in my gut, I'd rather be shorting in a bear market than going long in a bull market. I say that because I want you to understand my bullishness over the last 10 years is not because I'm some crazy permabull that continuously calls bull markets until they end and then just fade away. I enjoy the bear markets as well. So as I have continued to give nothing but bullish comments over the recent years, it is simply because the charts have unquestionably, unequivocally continued to show bullishness with no signs of any kind of a top or bear market forming. I want you to think of something else that may influence you. Why do analysts and hedge fund managers come on and say that the market is at a top when it is not? Well, there are two possible answers. First, they simply may not know. The market has been up for a decade, and quite simply, the number of bullish months compared to bearish months since 1990 is off the chart. But even if they do know, I hope you understand by this point that they are not on TV telling you that we're at the top to benefit you. They're doing it to benefit themselves and the fund that they run. That's all they care about. If they are saying the market's at a top, they are encouraging people to sell. Why would they do that if they were fully invested in their fund? The answer is that they would not. If the market gets carried away and they use their propaganda to help bring the market back, they do this so they can continue to become more invested in the market. The self-created pullbacks that they create to the extent that they can are used to buy additional shares because they're not fully funded yet. When a fund manager becomes 100% invested in the bullish market, why would they come on TV and say the market's at a top? It would be like slitting his wrists on public television. He's going to come on and say that the market has a lot of room to encourage the average Joe to jump in, to accelerate the market higher, or perhaps to promote enough buying that he can start his own selling. As I said a moment ago, we're not there yet, but there are some small signs forming. Look at this monthly chart. This has been a linear move. Let me go back to the ones a little more expanded here. This has been what we call a linear move. It's a very strong move. You may call it extended because it is pulling away from the moving average, but it is still linear and can continue almost forever. What's happening now, though, this month is we're starting to see acceleration at a point where the market has already gone beyond its upper channel limit and is moving at a faster rate higher than it has before. There's the monthly chart of the SPY, which of course looks the same. Here's the weekly chart. And we can see the weekly chart in here after all of this time up and after getting to what is typically the top of kind of a little range area, instead of rolling over and coming back to the moving average, it's gone above the top and now getting the biggest bar on the chart. This is what we want to see, but what we want to see is continue now for another 2 months and just go absolutely parabolic. That would be the greatest type of top that we could actually find. If that doesn't happen, it becomes more and more difficult to find if there actually is a top. I also just told you that naturally fund managers will do everything they can to keep money pouring into the market until they actually do want to sell. Here's a recent article from CNBC, and you can Google this. Just if you Google the title, I'm sure you find it. Investor fear of missing out runs wild as record amounts of money flow into the stocks the last 4 weeks. This is just from the last week. Actually, it's dated down there the 19th of January. If you get nothing else out of this video, I want to make sure that at least you personally have a plan. There are 3 stages of transitioning from a bull market to a bear market. First is when to stop the buying. Second is when to begin the selling process of the current longs that you own. And third is when to begin profiting from the move down. That's a very simplistic statement, and for many accounts it's not practical to sell, but you can take proactive measures to offset the bear market when it starts. The most important thing I want you to get out of this is that you have to have a mental plan ready now, even if we are a ways from the top. Because when it happens, you will be a deer in the headlights, and once we start falling, it becomes difficult to accept less than the maximum profit that you had. It's a natural human tendency, and things can fall really fast. I literally received an email from somebody, which is the proverbial story you hear all the time, but the guy actually showed me records. He bought Yahoo at $15, held on it to $250, and sold it at $13. Don't be that guy. Naturally, there's an excellent way to build a portfolio when you start going into a bull market, and how to handle it and how to become fully invested, and then how to start peeling it off in stages so that you never have to worry about hitting the top to the day. If you still have the majority of your portfolio, congratulations, you've done a great job. You have to come up with a plan of exactly how you want to handle this. When will we hit the top? Well, that really is a guess for even the best pro. Nobody knows for sure. I would suspect we're still probably 6 months to a year from hitting the top, maybe anywhere from May to the end of the year, somewhere in that range. It's possible we could accelerate very quickly and form quicker than that. I can't really tell right now. We have to live through it day by day. And as I close out this video, I want to make one other comment. Almost 10 years ago, I said that this bull market would last a decade, and it's very close to being true. When we do hit this bear market, going on record right here is saying, I think this will be the most devastating bear market that anyone listening to me has ever seen. If we do form the type of top that I discussed last, where we really accelerate through irrational exuberance, I think that the high form there will be the high of the market that anyone who's middle-aged or older will see in their lifetime. To put things in perspective, I want you to take a look at this chart real quick. I took the monthly chart and just compressed it down so you can go back to see all the way back to 00. Let's start here first. This is compressed down so you can go back and see the 08 debacle. This right here is 2008. This is the crash. This is the biggie. This is the one that people still talk about. It's almost starting to look like a blip on the chart. It was erased, of course, almost completely in 09 and was by 010. The market went on to double and triple, etc. And even up to here, this was an incredible rally. And now we're accelerating beyond that. That 08 crash looks like nothing. And if you go back to include, like I first had, all the way back to 00, this is the high of the tech rally of 99. This is a number we didn't think we'd maybe reach ever again. Now take a look at the crash of 08. We stalled at the prior highs, and we accelerated this far past here. I'm not going to go into all the details now. Some of it I think are pretty good facts, and some is a subjective opinion by myself. But I think if we do accelerate to that top, that this high will be the high for a long, long time. It's not one that you want to miss. This has become one of the greatest bull markets there's ever been, and it is not necessarily over yet. But you are at the point that I want to make sure you have a good mental framework of what you're going to do and how you're going to do it. Because if you don't have a plan ahead of time, I assure you, you will not act properly when the time comes. I have a subscription-based letter called the DTS Market Letter, and a second one starting up probably next week called the DTS Swing Core Position Letter. Both of these naturally discuss the market in great detail, and naturally subscribers to those will hear the blow-by-blow on a daily basis. I don't try and hide things from anyone else, but I don't come on all that often to talk about the market. And when things happen, they can happen very quickly. Oftentimes, the drop the first week or two can be so extreme that it gives back a lot of profit and or can make it difficult to exit positions because people wait for the next rally and sometimes it never comes. So be very careful and make sure you have your plan and that you know exactly how you're going to handle things. If all else fails, remember, if you go to your local butcher or hairdresser and they start telling you about their stock portfolio and all of the great stocks that they own and that they're now starting to trade Bitcoin, it's time to get out of the market. This has been Paul Lang from Disciplined Trading Strategies. You can feel free to visit my website or email me if you have any questions. Here's a closing slide that you can read. If you have any questions, feel free to get a hold of me. Take care, everybody. Good trading.